Hey, good afternoon, everybody. Chris Lester here. First and foremost, I want to say thank you for taking time out of your day to join us. We've been hosting these calls coming up on almost a year. And the format is every week we try and bring, content that's relevant, current as the economic landscape changes that we're taking and bringing to the forefront topics of conversations that you've expressed an interest in, trying to be consistent into our messaging so that you can start to see and become familiar with the landscape as it relates to whether it be finances or insurance or just in general, good financial planning. There's a lot of things over 2021 with the new administration that we should start to pay attention to and see if there's any adjustments that should start to be had along the way. Relax, sit back, write down your questions. Nothing's going to be sold here. This is not a solicitation. This is really just educational in purpose. And, until COVID, sort of gets, in check, we will continue to do this going forward. This webinar is called January Market Update, but understand that this is data as of the month of December. If you've not seen this, I'll take a little time to go through what we're looking at and what this means. This is a snapshot of the month of December, and there's a bunch of squiggly lines. But there's an indication that all things the month of December actually was pretty positive. So if you look from left to right, you see an upward trend, right? Now, each of the lines are a different color. It signifies or represents something very specific. So the winner of the race right now at a little above 8.5% for the month was the Russell 2000. The Russell 2000 are small cap funds or small businesses. And it's taken the top 2,000 small businesses across the country and people that put their money into these types of investments for the month of December, you got a return on investment. The second place winner, right, is iShares, which is emerging markets. So that pink line also did well. That's signified or typically represents the majority is China, right? So, China is starting to rebound. So that's where that pink line is coming into play. And now the leader of the pack for most of 2020 was gold, Spider Gold. That's that teal line. And it's just about 7% for the month, but it wasn't first place, right? So you'll start to see a little bit of optimism in the marketplace. You'll remember from last week, we started talking about tailwinds, right? That we think and indicators and technical indicators are showing a continued upward trend in the marketplace. And gold is typically a flight to safety. So it started to lose a little bit of steam overall for the year. You'll see in the next slide, we'll look at that, but just understand it still did well for the month of December. Now, the next line is that bright teal line, right? So that neon blue, I guess, is what we would call that color. And that is your commodities. Commodities actually started to pick up a little bit, but you'll see on the next slide from an annual perspective, it's gotten beaten up for so long that it makes sense that it's going to, start to have some upward trends. I think, that's really signifies that people are starting to look at, transportation industries, whether it be cruises, airlines, people are getting restless and people are looking to start to get mobile again. And as that starts to happen, it will start to utilize or use the reserves that are in place or the surplus that we had in place for typically it's oil, right, is the commodity sector. Next is that green line, bright green line, neon green. That's European developed market. Europe is actually, I was reading an article today, is actually positioned, where US has been the dominant world leader of late. Because Europe was so depressed for so long, people are starting to look at that as emerging markets, or I'm sorry, for international funds as a place to start to consider to look for yield and rate of return. The next one is the S&P, right? So, it did okay. I've said this for quite a few months, and I will continue to say this, that the S&P, right, which is a market cap weighted index, is predominantly being held up by five stocks, right? So when you look on TV, and this is why we always caution, you can't go by everything that you're seeing on TV. The economy's doing great. The economy, the sky is falling, right? We have to look at a broad base level of indicators to say, hey, you know what? This is what the signals are telling us. The S&P is one of those indexes that is on every financial news channel, and those five stocks is, it's Facebook, it's Amazon, it's Netflix, it's Google, right? So these stocks are carrying the majority of all-time highs, which were hit just this week, right? So, and then the last one is black, right? So real estate. And for the month, December, real estate did okay. So, December was a good month. But now some of the retail numbers for January are coming out, and we're starting to see a little bit of contradictory or a little bit of slowing, but we'll talk about that. And then now let's look at it from an annual perspective. All of 2020, year to date, from left to right, well, that looks a little more like what we experienced, right? That's a little scary because February, this time last year, COVID hadn't really even pronounced itself. Nobody was even really aware of it yet. And then all of a sudden, so we're moving along, and then the bottom fell out in every sector, right? Except for gold, right? People got scared, people got spooked, and they moved money into gold because that's where, from a flight to safety, that's a logical conclusion. And you can see as you go across, that's the leader of the pack. I mean, gold just 25% return on your investment in those indexes did really well. Now, what I find interesting is that the blue chips actually for the year finished up. So the Russell 2000 took second place above the S&P, but both of those are just strong indicators that, as we talked about early in this, COVID environment, Warren Buffett says, bet on America, right? And, we will get through this. We talked about that last year, and that is evident now as we look at 2020, right? And then you see right under, the red line, right? We see that pink line, which is now China, right? Emerging markets, those lesser developed countries where people are speculating and actually did well, but they all got crushed in March. Then we drop down to that neon green, the developed countries, European countries, and we see that just finished above 5%. So again, everything being in equities, overall, if you had a diversified portfolio, you probably started to see your portfolios recover and actually make some money for 2020. Now, the losers, the ones that actually, with everything that was going on, the two areas that got crushed were real estate. You could see that early on, never really recovered. And I don't know that we'll see any recovery here in the near future because as small businesses feel pressure, right, to meet their obligations to keep their doors open, if they can't keep their doors open, well, then they can't pay the rent. And people that have invested in, office buildings or in strip malls or commercial real estate, that's quite often what you see when you look at REITs and things of that nature. So, it makes sense that it didn't do so well. I'm surprised it came back as well as it did, but it still finished down for the year. And then ultimately, this is where oil just got crushed, right? Because commodities are predominantly, this ETF is made up predominantly of oil. Now, this next chart, if you've not seen this before, is very, very busy. There's a lot of information on here. I'm going to simplify it. There are three indicators here. It's called the bull bear indicator, but on the top portion is the relative strength index. The second one is the moving average, and the third one is the MACD, right? So these are the three indicators that we're measuring and triggers as we look at this. And what happens is it's a very simple sort of a barometer or a bellwether to sort of say, hey, what is the market? What are the headwinds? What are the signals telling us? Like a red light, green light, right? So if we're turning around, we're approaching an intersection, all the way to the left here, you see this red line. What this is basically saying is that all three of these indicators have turned negative. And when that happens, right, that it's typically expected that we will see a downward trend. And then when all three indicators turn positive, you get a green line. And they will typically, it indicates an upward trend, but it is not always 100% foolproof because you get head fakes in here. So right in here, you see that it went negative, but then it turned around and flipped. And that also happened this year. Then in 2008 happened, all the indicators went negative, and that was in fact a very steep sell-off there in the equities marketplace, only to turn around, right, in 2009 and start this upward trend that we've continued to ride, I guess, at least 15 years now, right? Since 2005, so we'll go 10 years. So 10 years going up. And then you see right here, though, this is what happened in March. This is that drop off, and all three indicators went negative. And for our clients, we had the conversation where, as we talked to our research department's trading desk, and we started looking at the economy as a whole, although COVID spooked everybody, we really felt that, maybe we want to take some risk off the table. But, being in the market, at least until the third quarter, and that seemed to be prudent advice. So a lot of the clients that went back and entered back into the market, even if they took a pause for a short time, have a lot of their portfolios have healed, and hopefully that's the case for you. Now, what I do find interesting here, though, we're still on this upward trend, but this crossover now is starting this up, and if this is one of the signals. If all three of these turn, we could see towards, and this is what I was talking about last week, we could start to see a turning of the equities market. So I would say keep a close watch as we continue to talk about this year. But, come August and September will be something to be, hey, is it continuing this upward trend? Is the economy maintaining momentum? Or do we see things that have caused a crossover, not only there, but in all three indexes, could cause you to maybe start to pull back and avoid some of these dips? And remember, Warren Buffett's rule to investing, I've been talking about this of late. Rule number one in investing is don't lose money. So you should be diversified. Diversification is a proven strategy, and don't buy one stock and bet the farm on it. It's typically not a good idea. Now we're going to shift over to the income markets, right? For the month of December, right? Again, this is not as pretty a picture, and think about what the income markets are saying here. This has been part of the conversations I've been having with clients of late. One of the things that you will start to find here and see is that the entire world is going to be seeking yield. Income portfolios and in a lot of the traditional wisdom that is offered through, your 401k providers or anybody that's a custodian for your accounts will typically say, okay, well, based on your age, based on the way that you answered your questions, based on where you are in your life. So let's say that you've now retired, and let's say that you're 70 and you're no longer working. Well, as soon as you stop working, you cut off the flow of income, right? So now whatever you have amassed during your working years now needs to be subsidized with either pension, which is, like I always say, a unicorn, Social Security, and whatever money that you've saved now has to last us for the rest of our lives. And this is why it's so important, because for people that retired 20 years ago, right, maybe they had designed and were counting on a portfolio's income, let's say it was 6%, right? So you're like, okay, I need 6% for my portfolio. Well, if you have $1 million in your portfolio and 6%, that's 60 grand a year. And you're going, that's what I need to be able to pay my bills. Well, if you now see yields are down around 2%, well, that's 20 grand a year on $1 million. Well, that's a huge shortfall. And that starts what we call the cannibalization of your asset, or a sequence of return risk. But income here for the month of December, we had about 5 of these asset classes were above the black line, right? So the blue, again, that's your high yield corporate bonds. So when I use the word high yield, the reason I gave this whole speech on yield in general is because everybody's seeking yield. People across the country, across all sectors, are looking to figure out strategies that will help them to subsidize this reduced yield environment, right? Interest rates are low, right? So it's not like you can go down to the bank and get in the Jimmy Carter years, you could get a 17% CD. Those days right now are gone, right? You're lucky you can get a CD for 1% right now, right? So if you need 4 or 5 or 6% on your money, that yield that it's supposed to generate, everybody is in that boat and they're all looking for options. So high yield bond, when you use the word high yield, I want you to substitute the word high yield for junk. So when you hear junk bonds, that just means that they're higher risk, right? They have a greater chance of default. And remember what I just talked about, Warren Buffett's rule number one to investing is don't lose money. And when you start to take more risk on your portfolio in an effort to seek yield, you can lose money. And that now the next colored is high yield munis, right? So both of those two things did very well in December. Let's see how they did annually. And then we drop down into the black, which is normal municipal bonds, because people just hear this and they're quite often touted through the broker dealers or the brokerage houses, munis, tax free, tax free, tax free. And to me, they don't talk about the risk, right? There's ways that you can get the yield that you're looking for. We can be tax efficient with what our strategies that we're trying to accomplish. But I think that these are often, these are passe or an old philosophy. And typically munis are for a higher, when I say higher net worth, I mean 3 million plus, right? So then let's look at the next one, pink. Vanguard Total International Bonds. So now we're looking at corporations internationally, right? All countries, right? Developed countries. So we look at that and we say, okay, that's pink, little above, not, zero point 0.2. And then the red, which is the U.S. aggregate bonds. So these are all the corporations in the U.S., Johnson & Johnson, Pfizer, Bristol Myers Squibb, any of the corporations that are housed and domiciled here in the U.S. have just in December turned around and went positive, right? The two negatives, the teal, right, are the short-term and the long-term treasuries. So what that's telling me, people needed yield. And what they started to do, where that was the flight to safety for all through 2020, for the month of December, people are going, you know what? I'm tired of earning nothing on my money. I got to go out and start to earn actually a rate of return, right? Or increase my yield. So now this is the annual snapshot. The annual snapshot shows that the 20-year treasury bond absolutely slayed the dragon, right? 18%, 17%. Right? It was just banner year. So when the bottom fell out in the income market as well, because things are typically, they're non-correlated, but the entire markets became correlated, right? And when they turned around and started to say, where can I put my money in safely? And that they turned to treasuries, gold, both long-term and short-term, which are the top two, right? So the neon blue and the neon green, those take the top two spots. The third one, U.S. aggregate bonds. So again, bet on the U.S. It finished the race from an income above 6%. So people that rode that wave stayed in their corporate bonds right now, and that worked for 2020. It may work for 2021 as well. But long term, I have concerns about, I think rising interest rates are on the horizon, and I don't have a crystal ball. I'm just telling you that experience has shown, history has shown, right, that when things cannot stay this depressed forever, although Japan had 20 years of negative interest rates. But if this starts to really turn ugly and people say, hey, banks are, bread and inflation and all the things that we've heard horror stories over the years does manifest itself, we could see portfolios that are heavily weighted in bonds absolutely lose their shirts, because bond portfolios, A, you can lose money, and B, do not like rising interest rates. So we have to start to think about and be creative about other alternatives for gaining yield. And now I'm going to talk about that in the coming weeks, about some strategies that you can start to look for and to utilize. The next three are sort of all right around that 3.5, 4%. So you got the black, you got your normal muni bonds, you got your total international bond funds, and then you have your high yield corporate bonds. So for the year, everything seemed to be on the plus, right? Which is all good news. So 2020 your portfolio is probably healed unless you moved to cash and you did not re-enter the market, right? So that is not the worst decision you can make, but that's also why we also say you can't time the market. So if we're going to be strategic in exiting the market, we should also be strategic in re-entering the market. And I do believe in the market. And that's part of the job of a solid financial advisor, is helping you manage emotions, helping you to discuss what's likely and probable going forward. But again, the last one there is the high yield munis, right? They just got back to even, but they got crushed during the year. And that's why, I would say just be cautious as to some of the advice you may or may not be getting. Now let's look at the bull and bear indicator for the aggregate bonds. Again, this is a red light, green light, the same indicators, relative strength index. We have our moving average crossover, and then we have our MACD, which is moving average convergent divergence, right? And if you see this last green line, all right, is that we've been on an upward trend for bonds, right, since 2019. And that just now, though, I see a convergence of all the data. And that sort of supports some of the concerns that I was just talking about. And you see that last indicator all the way here at the bottom. You see that I don't know if it's going to cross over, but if these three indicators start to cross over, then we could start to have red lines in the income portfolios as well, and they could get triggered. So, 2021, my advice is stay in the market, stay close with your financial advisor. If you're doing this yourself, I really would ask you to get professional guidance. Fees are only an issue in the absence of value. And typically when I'm discussing portfolios with clients, depending on your age, depending on your risk tolerance, but I think reasonably that in today's environment, we should be able to achieve 5.5% to 6% net of fees. And so you're going, well, my portfolio last year did 10%. Okay. But you know what? I always hear that's like the person that goes to Atlantic City. They come back and told you they won. But then they went the next 3 weekends, you don't hear from them. They never tell you when they lose, right? Let's take the gambling out of investing. Let's use strategies, philosophies, indicators, and common sense as we approach the markets, because unlike, maybe while we're working, we might afford a little bit of risk. There's no do-overs in retirement. Once you run out of money, then your entire lifestyle changes. All right, so the last indicator that we have is actually a proprietary. It's called the RPA, which is a recession probability analytical tool. This is a proprietary tool that was created by Formula Flows. And basically, it just says it uses 100 different data points to determine, what is the probability or likelihood of a recession. And you can see that went above the 50 percentile line. Once that crosses over, it's just now we're starting to see indications that a recession could be on the horizon. But since it started a downward trend last May and has continued and has stayed below that 50% line since then. And the last 3 months have been pretty even. So we continue to monitor this. It's just a bellwether. And it allows us to sort of keep an eye on the landscape, taking a lot of things into consideration to give us a sort of a generic pulse on the economy and indicators going forward. So lastly, let's talk about our compliance says that we have to show, disclosures. This is just that, Retirement Wealth Advisors is my RIA, that's a registered investment advisory firm. Basically, they're my compliance department, big brother, investment team, strategist, all that. So I've shown that. And then lastly, I want to thank each and every one of you. If I can educate you along the way, if I can help you to understand just the pure volume of information that we're inundated with and reduce your stress level. Retirement's supposed to be about enjoying life and giving back and serving your community and all the things that we believe in. I want to say thank you to each and every one of you. Don't keep me a secret. Hope to see you on here next week. And if ever I can do anything for you, reach out. Send me an email. Give me a call. Happy to help. God bless. Have a great day. Bye-bye.